There's a feeling that every trader knows. Not the excitement of a winning trade, not the sharp sting of a loss, not the adrenaline of watching a position move in your direction in real time. Something quieter than all of those. Something that lives in the space between what's happening and what you're telling yourself is about to happen. It feels like faith. It feels like patience. It even feels sometimes like wisdom, like you're the calm one in the room, the one who isn't panicking, the one who sees further down the road than the people selling around you. It feels reasonable, measured, almost noble, and it is destroying your account one day at a time. The feeling has a name. It's not a complicated name, it's not a psychological term or a behavioral finance concept with a Latin root that makes it sound more sophisticated than it is. It's hope. Simple, human, deeply familiar hope. And Jesse Livermore, the man who studied the mechanics of trading loss more honestly and more rigorously than almost anyone who has ever participated in financial markets, believed that hope was responsible for more trading destruction than bad analysis, bad timing, bad systems, and bad luck combined. Luck. Not because hope is wrong as a human value, not because there's something broken about a person who experiences it, but because in the specific context of an open losing position, hope stops being a virtue and becomes something else entirely. It becomes a mechanism. A quiet, invisible, completely convincing mechanism that keeps you in trades you should have left, costs you money you could have kept, and does damage to your psychology that takes far longer to repair than the financial loss itself. This episode is about that mechanism, how it works, why it's so hard to see from the inside, what Livermore learned about it across 40 years in markets, and what you can actually do about it, not in theory, but in the specific, pressured, real money moments when it's most active and most dangerous. By the end of this, you will never hear the word hope in the context of a trade the same way again. Let's go. Before we get into what hope does to a trade, I want to make sure we understand exactly what kind of hope we're talking about, because there are two kinds, and they feel almost identical from the inside, even though they are functionally completely different. The first kind of hope is analytical. It's the hope that is grounded in a genuine re-examination of the facts. You're in a losing position. You look at the evidence again, the tape, the fundamentals, the macro context, the technical structure, and you find real reasons that weren't fully incorporated in your original analysis, to believe the trade may still work. The underlying thesis remains sound. The price action, while adverse, is within the parameters of what a valid trade would look like at this stage. There are specific, identifiable conditions that would tell you when that assessment changes. This hope is legitimate. It's not comfortable. It requires real intellectual honesty to distinguish from its counterpart. But it's real. It's grounded. And it's the kind of thinking that allows a trader to hold a position through normal volatility without being shaken out of a trade that eventually works. The second kind of hope is emotional. It's not grounded in re-examination. It's generated by the discomfort of being wrong, by the financial pain of a losing position, by the ego's need for the trade to recover. It wears the clothing of the first kind. It uses the same vocabulary, the same reasoning structures, the same analytical framing. But underneath the clothing, it's doing something completely different. It's not evaluating evidence. It's avoiding pain. Livermore spent years trying to articulate the difference between these two kinds of hope, not because the intellectual distinction was difficult. He understood it clearly. But because living the distinction, in the heat of a real trade with real money moving against you in real time, is one of the hardest things a trader ever has to do. Because from the inside they feel the same. That's the trap. That's what makes hope so specifically dangerous in trading. Not that it's obviously wrong, that it's obviously reasonable, that any sensible person looking at the internal experience of hoping a trade comes back would nod and say, yes, that seems like a fair assessment of the situation, and the account keeps going down. Let me take you inside a specific experience, not Livermore's, yours. You placed a trade. The setup was real. You didn't force it. You waited for it. It met your criteria. You entered with conviction. And for a while it looked like it might work. The position moved in your direction, Not dramatically, but enough to feel right, enough to feel like the thesis was being confirmed. And then it reversed. Not catastrophically, not the kind of move that triggers a margin call or wipes out the position. Just a steady, grinding, relentless move in the wrong direction. The kind that happens slowly enough that each individual day doesn't feel like a decision point. Each individual session is close enough to the prior session that exiting feels premature. The loss is real, but it's not yet large enough to be undeniable. This is the window. This is where hope does its most damaging work, because in this window the trade is neither clearly right nor clearly wrong. The price is in no man's land, moved against you enough to be painful, but not enough to be decisive. And in that ambiguous space, the mind fills the uncertainty with something. It fills it with narrative. The narrative sounds analytical. It references the original thesis. It notes that the fundamental reasons for the trade haven't changed. It points to historical examples of similar situations where the price recovered. It finds the chart pattern that could be interpreted as a consolidation before the real move. It identifies the upcoming catalyst, earnings, a Fed meeting, an industry report, that could be the thing that finally confirms the direction. Every element of the narrative is plausible. Some of it might even be true. But the narrative was not generated by an honest re-examination of the evidence. It was generated by the need to not exit, by the emotional weight of a loss that hasn't been taken yet, by the part of you that knows that closing the position means admitting the trade was wrong, and has decided, without announcing the decision consciously, that it would rather keep the loss open than take the psychological hit of closing it. Livermore called this living in the trade, and he said it was one of the most dangerous states a trader could occupy. Not because the trade was necessarily doomed, but because in that state, the trader was no longer capable of evaluating it honestly. You can't assess a position clearly when you need it to work. He had a phrase, simple, direct, almost blunt in the way that his best insights always were, that he used to describe what hope does to a trader's judgment. He said hope makes you deaf to the tape. Think about what that means. The tape, the actual price action, the real-time behavior of the market, is speaking. It's communicating something. Every tick is data. Every session that closes in a specific place is information about the balance of supply and demand, about the line of least resistance, about whether the thesis you're betting on is being confirmed or denied. The tape is always talking. The question is whether you're listening. Hope makes you deaf. Not completely deaf. You can still see the numbers, but the interpretation of those numbers and the meaning you assign to the price action, the narrative you build around the data, gets filtered through the need for a specific outcome. And that filter is powerful enough to turn the clearest market communication into ambiguity. To turn a stock that is obviously distributing, obviously weakening, obviously moving in a direction that contradicts your thesis, into a stock that is consolidating before the next leg up, into a stock that is shaking out the weak hands, into a stock that the market is temporarily mispricing. The tape is saying one thing, hope is translating it into something else, and you believe the translation, because it was generated by your own mind, because it uses the vocabulary of your own analysis, because it sounds exactly like the kind of thinking that produced your winning trades. It has all the characteristics of real insight, except that it's in the service of avoiding a loss rather than in the service of finding the truth. Livermore experienced this himself. He described it not with embarrassment, but with a kind of clear-eyed curiosity, the curiosity of someone who had studied his own psychology long enough to see its patterns with genuine objectivity. He wrote about sitting in positions that were clearly broken, reading the tape every day, and finding in each day's price action some fragment of data that the hoping part of his mind could grab onto. A day where the stock closed above a specific level, a session where the selling pressure seemed to ease, a morning where the opening strength looked like it might be the beginning of the recovery. Each of these fragments was real. The data was real. But the interpretation, the weight given to these fragments versus the weight given to the overall trajectory, the overall direction, the overall message of the tape over days and weeks, was being distorted by what he needed to see. He called this selective listening. The market was saying many things. Hope was selecting the ones that supported staying in and filtering out the ones that didn't. Now I want to go somewhere that most discussions of this topic don't go, because understanding that hope distorts judgment is one thing. Understanding why it's so hard to interrupt, why even traders who know this, who have studied it, who have Livermore's exact words on the subject committed to memory, still fall into it consistently, that requires going a level deeper. Hope in the context of a losing trade is not just an emotional response, it's a defense mechanism. And understanding it as a defense mechanism changes what you can actually do about it. Here's what it's defending against. When you close a losing trade, several things happen simultaneously. The financial loss becomes real, not potential, not on paper, but actual and permanent. The money is gone. That's painful, obviously. But the financial pain is often not the worst of it. What's worse for most traders, and Livermore observed this in himself and in everyone he watched trade, is what closing the loss means about the trade, and what it means about you. Closing the loss means the trade was wrong, which means the analysis was wrong, which means the judgment that generated the trade was flawed, which means you, the person who prides themselves on analytical capability, on market knowledge, on the ability to read conditions and make sound decisions, made a mistake. Not a catastrophic mistake, not a stupid mistake, but a mistake. And for traders who have built their professional identity, their sense of competence, their self-regard, around the ability to make good trading decisions, that acknowledgement carries weight that goes well beyond the financial loss. It's not just I lost money on this trade, it's my judgment was wrong. And for certain personalities, the ones most drawn to trading, the ones most likely to succeed at it in the long run, that second statement is the harder one to sit with. Hope defers that statement. It keeps the possibility alive that the judgment was not wrong, that the trade will yet prove itself, that the analysis will be vindicated, that the temporary adverse move was the aberration and the recovery is the real direction. As long as the position is open, the verdict is not in. And hope is the mechanism that keeps the position open. Livermore understood this with a precision that I think is genuinely remarkable. He said the problem with hope in trading is not that it feels bad, it's that it feels so much better than the alternative. The alternative, accepting the loss, closing the position, sitting with the discomfort of having been wrong, is immediately painful in a way that holding and hoping is not. The pain of holding and hoping is deferred, distributed across days and weeks, never arriving all at once, and the human mind is very good at preferring distributed, deferred pain to immediate, concentrated pain, even when the math is clearly worse. We will choose a slow bleed over a sharp cut almost every time, not because we're irrational, because we're human. There's a consequence of hope that Livermore wrote about that doesn't get discussed enough. Not the financial consequence, the psychological one. He called it the drain. Every day you hold a position you should have exited. Every session you spend in a trade that the tape has already told you is wrong costs you something beyond the loss in the position. It costs you bandwidth, cognitive and emotional bandwidth, the kind that once spent isn't available for the next decision. Think about what it actually takes to hold a losing position through hope. You have to re-examine the thesis every day, to rebuild the case for staying in. You have to reinterpret the price action every session to find the fragments that support the narrative. You have to manage the emotional discomfort of the unrealized loss, the background hum of a number in your account that doesn't match where it should be, while trying to function normally in the rest of your trading. All of that takes energy, real finite, depletable energy. And while that energy is being consumed by the hope maintenance process, by the daily work of keeping a broken trade alive in your mind and your portfolio, it's not available for anything else. Not for the objective evaluation of new setups, not for the clean-eyed reading of the tape, not for the patient waiting for a genuine high-probability opportunity. You're full of the noise of the open losing position, full of the narrative maintenance it requires, full of the emotional weight of a verdict that's been deferred but not avoided. Livermore described watching traders miss genuinely excellent opportunities, setups that were as clean and clear as any they'd ever seen, because their attention was entirely consumed by a losing position they couldn't bring themselves to close. The new opportunity was right in front of them. The tape was communicating clearly. The pivotal point was obvious. But they couldn't see it. Because they were looking at something else. Because hope had narrowed their field of vision to a single trade, the broken one, and everything else in the market was background noise. The losing position that should have been closed 2 weeks ago was not just costing them money in that position. It was costing them the money they could have made if their attention had been free. This is the real cost of hope. Not just the loss in the trade, the opportunity cost of everything the trade prevents you from seeing clearly. I want to talk about something that Livermore identified as the moment of maximum danger, not the moment when hope first appears. That's manageable. That's early enough that the rules can still do their work. The moment of maximum danger is later. And it's counterintuitive. He called it the first recovery. Here's what he meant. You're in a losing trade. The position has moved significantly against you. The loss is real and growing. And you've been in it long enough that the hope narrative has been fully constructed and is running on autopilot. You know all the reasons the trade should work. You've repeated them to yourself enough times that they feel like fact rather than wish. And then the stock recovers. Not to your entry as not to break even buyers, but meaningfully. Enough to cut the loss substantially. Enough to feel like vindication. Like the narrative was right. Like the patience was rewarded. This is the moment of maximum danger. Because in this moment, when the loss has reduced and the hope feels confirmed and the trade feels alive again, the rational decision is often to exit. To take the reduced loss and be grateful for the recovery. To recognize that the trade gave you a second chance and to use it. But that's almost never what happens. What happens is that the recovery feels like proof. Proof that staying in was right. Proof that the hope was valid. Proof that the next move, the move to break even, the move to profit, is coming. So you hold. The reduced loss feels almost comfortable after the larger one. The narrative is louder than ever. The confidence in the thesis, temporarily shaken by the adverse move, has been restored by the recovery. And then the stock reverses again and goes lower than before. And now you're in a worse position than you were at the worst point, with the added psychological burden of having had a way out and not taken it. Livermore described this pattern: the losing trade, the partial recovery, the renewed hope, the second decline, the deeper loss, as one of the most reliably destructive sequences in all of trading. Not because it's unusual, because it's common, because the partial recovery activates hope at exactly the moment when a clear-headed assessment would say exit, because the timing of the recovery is cruel in exactly the way that most discourages the most rational response. He said the market, if it were designed by someone trying to maximize trader losses, could not have been designed more effectively. The partial recovery is the market's way of giving hope one more piece of evidence, one more reason to stay, right before the next decline arrives. He was not being conspiratorial. He was being observational. This is simply what happens when human psychology meets market volatility. The moments of relief, the recoveries that feel like vindication, are precisely the moments when discipline is most needed and least available. So what did Livermore actually do about it? Because everything I've described so far is a diagnosis, and a diagnosis without a treatment is just a more sophisticated way of feeling bad. His answer was structural, and it had two parts that worked together in a way that's important to understand. The first part was the predetermined exit. Before any trade was placed, in the calm, objective, ego-free state that precedes the emotional engagement of an open position, he identified the specific price level that would tell him the trade was wrong. Not wrong in his opinion, wrong in the market's verdict, the level at which the thesis was definitively invalidated, the point past which there was no legitimate analytical case for staying in. And he committed to that level before the trade was on. He wrote it down, made it concrete, made it the answer to a question he had already asked, and answered, "At what price am I wrong?" That answer, made in advance in a state uncontaminated by hope, was binding. Not a suggestion, not a starting point for in-the-moment negotiation, the binding answer of the clearest version of himself applied to the compromised version of himself that would be operating when the level was approached. The second part was equally important and less often discussed. He treated every exit at a predetermined level not as a defeat, but as a completed trade. Not a trade that failed, a trade that was completed according to its terms. The terms included the possibility of being wrong. The exit at the predetermined level was the execution of those terms. This reframing matters more than it might seem, because the psychological resistance to taking a loss is deeply tied to the narrative of failure. Closing a losing position feels like admitting defeat, like being wrong in a way that reflects on your ability, your judgment, your worth as a trader. But if the exit was predetermined, if closing at this level was always part of the trade structure, then it's not defeat, it's completion. The trade was designed to end here if the thesis wasn't confirmed. The thesis wasn't confirmed. The trade ends here. That's not failure. That's the plan working exactly as designed. This distinction between a loss as failure and a loss as the predetermined outcome of a thesis that wasn't confirmed changes the emotional experience of taking it. Not completely, not painlessly, but enough to make the action possible in moments when the hope is loudest and the resistance to acting is strongest. There's something Livermore said about hope that I've carried with me for a long time. It comes from his writing, and it's one of those statements that sounds almost harsh when you first encounter it, but that reveals something true and important the longer you sit with it. He wrote that hope in the context of a losing trade is the enemy of the trader wearing the face of a friend. The enemy wearing the face of a friend. Think about that. Hope doesn't announce itself as something dangerous. It doesn't arrive in a form that triggers your defenses. It arrives in the form of something you value: patience, faith, conviction, the willingness to hold through volatility for the eventual reward. All of those are genuine virtues in the right context. All of those have served you well in other situations. But in the context of a trade that the tape has already told you is wrong, in that context, those virtues are being impersonated. Something that serves the ego's need to avoid being wrong has put on the clothing of patience and conviction and is walking around in your head looking like wisdom. And because it looks like wisdom, you trust it. You listen to it. You let it make the decision that a cleaner, calmer, pre-trade version of you already made correctly, and override it. The enemy wearing the face of a friend. Once you understand hope in trading that way, once you genuinely internalize that the feeling of patient conviction in a losing trade is almost always disguised ego protection rather than genuine analysis, something changes in how you experience it. You don't stop feeling it. Hope doesn't disappear once you name it, but you stop trusting it automatically. You start to recognize it for what it is the moment it appears, not a signal to hold, a warning sign, evidence that the defensive psychology has engaged and that the pre-trade framework, the binding answer of the clearest version of yourself, needs to be consulted. Not the hope, the plan. Always the plan. Let me bring this to you directly, because this isn't abstract. This is happening in trading accounts right now. There's a position somewhere in your history, maybe in your current account, maybe in a trade from last month, maybe in something you closed years ago and still think about, where hope was the deciding factor, where the tape was telling you one thing and the feeling was telling you something else, and you listened to the feeling. You know the trade I'm talking about. You don't have to think hard to find it. Now think about what it would have looked like to listen to the tape instead, to have had the predetermined exit in place, the answer to "at what price am I wrong?" written down before the trade was on, to have hit that level and acted on it. Not painlessly. The pain of the exit was real, but cleanly, completely, with the loss defined and the attention freed. Think about what came after the exit in that version. The cleared headspace, the capital preserved, the absence of the daily drain of maintaining a broken thesis, the ability to look at the next opportunity with clear eyes rather than eyes clouded by the noise of an open losing position. That version isn't painless. Losses never are, but it's functional. It's the version where the loss stays small enough that it doesn't define the week, the month, the quarter. The version where the next opportunity gets the attention it deserves. The version where the account tells a story of consistent, disciplined risk management rather than a story of occasional big wins buried under the damage of losses held too long. That version is available. It's available in every trade. The only requirement is the willingness to make the binding decision in advance and to honor it when the hope starts talking. Livermore made that binding decision his whole career. Not always successfully. He said so himself with the honesty of someone who had paid for the failures, but as a principle, as a commitment, as the foundational structure of a trading methodology that produced results that haven't been equaled. He made it, and he kept coming back to it. Every time the hope had won and the losses had mounted and the rebuilding began, he came back to the same structure, the predetermined exit, the plan made in clarity, the binding answer of the best version of himself. Because he knew, from the inside, from the experience of losing to hope and recovering from it more than once, that hope, wearing the face of a friend, was always going to be there. In every losing trade, in every ambiguous market moment, in every situation where the tape was saying one thing and the ego needed something else, the plan was the only thing that was stronger. Here's the one thing I want you to take from this episode. One concrete, specific, immediately applicable thing. Before your next trade, before you enter, before any money is at risk, before the emotional engagement that comes with an open position, write down the answer to this question. At what price does this trade prove me wrong? Not at what price do I get nervous? Not at what price do I start to reconsider? The specific price at which, by your own pre-trade assessment made now in this calm state, the thesis is definitively invalidated. Write it down, commit to it, and then, and this is the part that makes the difference, make an agreement with yourself, an explicit, conscious agreement. The agreement is this: when that price is reached, the trade is over. Not probably over, not worth reconsidering. Over. The predetermined exit is executed. No new information considered in the moment. No narrative evaluated. No hope consulted. The plan is executed. Because the plan was made by the version of you that wasn't under pressure. The version that didn't need the trade to work. The version that could evaluate the evidence without filtering it through hope. That version made the right decision. Your job when the level is hit is not to reevaluate the decision. Your job is to honor it. Livermore built his entire career on that discipline. Lost it, rebuilt it, lost it again. But always came back to it. Because he knew, more clearly than almost anyone who has ever traded, that hope would always be there. Always waiting. Always wearing the face of a friend. And only the plan was stronger. We're 3 episodes into this Jesse Livermore series, and if you've been with us from the beginning, you're starting to see the architecture of what he understood. Episode 1 was about recognizing that the market is not the enemy. Episode 2 was about why intelligence makes self-deception more dangerous, not less. And this episode is about the specific emotion, hope, that does the most damage and is the hardest to defend against. These aren't separate ideas. They're the same idea seen from 3 different angles. The enemy is internal. It's sophisticated, and it wears the most convincing disguises available. That's the thread. That's what the next 47 episodes are built on. LC Books and Life goes this deep every episode. Trading psychology, risk management, patience, probability, market reading. Every dimension of what Livermore understood, taken seriously and explored fully. Subscribe so you're there for everyone. Livermore's books are in the description. How to Trade in Stocks and Reminiscences of a Stock Operator. If this episode landed for you, those books will hit differently now. Go read them. See you in next episode.